Imagine if you could earn more interest on your savings without locking your money away. Sounds too good to be true? Well, it's not. Money market accounts offer the perfect balance between earning higher returns and keeping your funds accessible for emergencies or big purchases. Today, you'll discover how they work, why they might be right for you, and what to watch out for. So let's explore how to make your money work smarter, not harder. First off, let's talk about what a money market account is. At its core, a money market account is a type of deposit account offered by banks and credit unions. It's like a hybrid between a savings and a checking account. You earn interest on the money you keep in the account, and typically, the interest rates are higher than what you'd get with a traditional savings account. But unlike most savings accounts, many money market accounts also let you write checks or use a debit card. That's where the flexibility part comes in. Now, you might be wondering, how is that different from a regular checking account or savings account? Well, with checking accounts, the focus is on ease of access, writing checks, paying bills, and making frequent transactions. On the other hand, savings accounts are designed for, well, saving and usually offer lower interest rates but fewer transaction options. A money market account sort of bridges the gap between the two, offering better interest rates while still giving you some access to your money when you need it. So how does it actually work? Well, when you deposit money into a money market account, the bank or credit union typically uses those funds to invest in short-term, low-risk securities like treasury bills or certificates of deposit. That's why they're able to offer higher interest rates compared to regular savings accounts. And don't worry, your money is still insured by the FDIC or NCUA up to the standard limits, just like it would be in a savings or checking account. It's a low-risk way to grow your money while keeping it accessible. Speaking of interest rates, let's get into that a bit more. One of the main reasons people choose money market accounts is for the interest. The rates can vary depending on the financial institution and market conditions, but they're usually tied to what's happening in the broader economy. When interest rates go up, the returns on money market accounts often go up too. That's great for savers, especially if you're trying to build up a cushion for emergencies or short-term goals. And here's a tip. Some banks offer tiered interest rates, meaning the more you deposit, the higher the interest rate you might earn. So if you're planning to stash a significant amount of money, it's worth shopping around for an account that rewards higher balances. But even if you're starting small, those higher rates can still make a noticeable difference over time compared to a regular savings account. Now let's talk about accessibility because that's another big perk. Unlike certificates of deposit, where your money is locked up for a set period, money market accounts usually let you withdraw your funds whenever you need them. However, there's often a catch. Many accounts come with limits on how many withdrawals or transactions you can make each month, often around 6, due to federal regulations. That's something to keep in mind if you anticipate needing frequent access to your funds. And while we're on the subject of things to watch out for, let's talk fees and minimum balances. Many money market accounts require a higher minimum balance to open or maintain the account, sometimes in the range of $2,500 or more. If your balance drops below that threshold, you might get hit with a monthly fee. So, this type of account works best for people who can consistently keep a higher balance. Another thing to consider is that not all money market accounts are created equal. Some might offer attractive interest rates, but come with stricter rules or higher fees. Others might have great flexibility, but slightly lower rates. That's why it's so important to compare options. Look at factors like the APY or annual percentage yield, any fees associated with the account, and what kind of access you'll have to your money. Now, you might be thinking, is a money market account right for me? The answer depends on your financial goals. If you're looking for a safe place to keep your money while earning more interest than a traditional savings account, and you don't mind maintaining a higher balance, it could be a great fit. It's also a solid option for an emergency fund, since your money is accessible but still working for you by earning interest. But if you're someone who needs frequent access to your funds without any transaction limits, or if you're working with a smaller balance, you might want to consider alternatives like high-yield savings accounts or no-fee checking accounts. The key is to align your choice with your financial habits and goals. Before we wrap up, here's something to think about. Money market accounts are just one tool in your financial toolbox. They're not necessarily better or worse than other options, just different. What matters most is finding what works for your specific situation. And if you're ever unsure, don't hesitate to ask your bank or credit union for details. They're there to help you make informed decisions. So, what do you think? Does a money market account sound like something that could fit into your financial plan? Let me know your thoughts or any questions in the comments, because I'd love to hear what's on your mind. Remember, growing your savings doesn't have to be complicated. It's all about taking small, intentional steps that add up over time. Thanks for joining me today, and I'll see you in the next one.